Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through a bunch of different ratios, see how they're interacting with each other, seeing if we can get any information from price an asset versus an asset. I'm going to give you my financial opinions, and we're going to dive right in here to see what's going on with the ratios. Again, if you guys need any help with anything, check out finding-value.com. You can become a platinum member, become part of the community. Love to have you part of the community. So let's dive in. Let's take a look and see what's going on. I'm going to start with the platinum to gold ratio. So we're seeing the ratio kind of dip here on the right hand side, right there. Boom. We're down at 0.48. 0.48 is an incredibly low ratio for platinum. It's incredibly cheap. Now, a couple of things stick out. We came to a very high ratio and we dived both of these times. In 2001, we had a recession. Over here, 2008, recession. Now, we're diving kind of a little bit. I mean, we're at a very low level, but we are diving with some, degree over here. Is this indicating a slowdown? Maybe, maybe not. I don't know. But nonetheless, we are at a very cheap ratio, 0.48. Platinum is definitely off the charts cheap, literally. Platinum to silver ratio, or platinum to palladium ratio, sorry. Platinum to palladium. Again, we can see a vast outperformance of palladium as we go all the way down here from 2009 all the way to the bottom of 2020. 2020, we were doing a little bit of basing out, doing some trampoline jumps. We've come back up to 0.71. That is also incredibly cheap. We hit a bottom last bear market at 0.60. So we're almost at the bottom of the bear market in 2001, it looks like, 2001. And that ratio vaulted all the way up to about 5. So if you were to look at history and you're kind of do what's the average ratio of platinum versus palladium, you're looking kind of at 2, 2.5, 3, somewhere in that range is kind of an average ratio. And right now we're at 0.71. So we're just waiting for market conditions. We are running deficits in both of these metals now. It's supposed to be a pretty big deficit in platinum this year. We'll see what it ends up being. Some projections are about 1 million ounces deficit. People have substituted palladium for platinum, and that is also increasing the deficits in platinum because of the price differential that they use in catalytic converters. Moving on to platinum to silver ratio, we are still at a very cheap ratio. We're at 41. Our lows here in 2011 was 39. Our low here was 33, and we're at 41. We've broken out of this pattern, and it does look like to me on a long-term basis that we could work our way higher against silver. Platinum is in fact cheaper than silver. I know a lot of people say silver is the cheapest asset. It's not the cheapest asset. Platinum's cheaper than it, at least. And I'm sure there's maybe a few other assets that may be cheaper than silver. Gold to silver ratio, we are still compressing upwards a little bit. Generally, when this goes up, gold is outperforming silver, and it may mean that we're in a certain market condition, more like a disinflationary period where gold outperforms silver. But when silver gets moving, it can rapidly change its ratio. Here is a top of 113 all the way to a bottom of 62. It doubled almost in its ratio in a very short period of time against gold. But right now, gold has been holding on. We are below a lot of resistance levels, and I do believe that this will eventually work its way down where silver will outperform gold. But right now, silver's cheap to gold. It's at 85.68. Palladium to silver ratio. So uh, during bull markets of commodities, you generally see silver outperform palladium. Went to a very low level of 15 in 2009. That's when you want to go. That's when you want to go gangbusters on palladium, as palladium was cheap against all of the metals in 2009. And then we had a gigantic bull market. Notice something in this ratio. You could have bought a lot in 2009. It went up, came back down in 2011. So you're in it for 2 years. You're still in it. 2012. Hey, this isn't going anywhere. Then boom, multiple hits here going into a blow off top. So if you are going to accumulate, you could accumulate for a while. This was cheap. It turned the corner in '04. Was cheap all the way till 2012, and then gave you just massive returns after that. So ratio investing does require some patience. Some assets may feel like they don't do anything for a while. Dow Jones to gold ratio. Big picture view, expensive, expensive, expensive as heck. We've come down from that level and we're at 17.56. 17.56. The peak of the 1929 bull market was 18.5. We're very close to the peak of the 1920s bull market. I do think that this will eventually work its way down. And could we see a surge to the upside? We might be able to see one, but I would say more than likely that this will grind its way lower eventually. We can see very strong downward pressure here, and we're struggling to go higher. So I would think that this is going to work its way lower. And gold's going to outperform the Dow Jones Industrial Average in the medium term. Gold to Dow Jones, this is flipped around so you guys can see it from a different perspective. To me, we've got that nice double bottom that is forming. Big move lower. We're putting in the double bottom, and we're at the right-hand side of the double bottom. We've broken the downtrend line, and now we're going to flail around a little bit, it looks like. And hopefully we'll work our way higher where gold outperforms Dow Jones. And gold is at a very cheap ratio, and this is maybe even a bigger double bottom. The whole thing. The big kahuna. Gold versus oil. We're at 27.67. Again, that is a very cheap ratio for oil, and gold's cheap to everything else. But it takes time, and we've been moving a little bit higher in this ratio. Is there a slowdown? Is something going on? Yeah, there is. There is a slowdown in inflation. And eventually, I think this is going to turn and head lower. It is going to compress to a level that is very low, probably below 10, maybe even below 6, 7, somewhere in that range might be where this compresses to. What does that mean? If gold goes to 25, 2,800 and it compresses down to 7, that's $400 oil. If that ratio were to compress like it has in previous bull markets. Crude oil versus natural gas. We talked about it at 39.4. I said, this is cheap. Look for it to come back down. And what's it doing? It's coming back down. We saw that also in 2012. So we could see natural gas outperform oil. If you notice something here, this ratio, it's been expensive in this region here from 1993 all the way till 2008, and it's been cheap ever since. It's been above this average line. So yeah, that's what we're seeing, and we're at a very cheap level for natural gas, and I think this is going to compress down to a level that is probably going to be under 12. The energy content in crude oil versus natural gas and the way they measure it, the unit of measure, is a 1-to-6 ratio is the energy content. Crude oil versus gold. It looks great for crude oil. We had an outperformance region for crude oil versus gold. That started in '86, ended in 2008. Ever since we've been in a bear market, '08 all the way to the bottom of 2020, and we just recently broke out of that downtrend line. This is a big deal. This is where crude oil could outperform gold for what I think could be a commodity bull market. And that is where our outperformance is going to come from. Is this breakage of the downtrend pattern, which is a falling wedge, and then a big break, hopefully, to the upside. So here's crude oil versus Dow Jones, crude oil versus stocks, kind of getting that double bottom again. We are at a very cheap level. Stocks are expensive to crude oil. This bottom here, well, it says zero, but either way, what would it be if we could get all the way back up to the peak here? That'd be an outperformance of crude oil versus Dow by 1,225%. How does that happen? Well, it's going to probably be a combination of crude oil going up and Dow Jones going down. Won't be from one asset class, just moving higher. So here's Dow Jones versus crude oil. We could see last bull market. Let's go to the last bull market here, guys. So we came up in an outperformance matter from the early 80s all the way to a peak of 98. We came down, broke the downtrend line, came up and retested this cheap area and compressed all the way back down in 2008. So Dow Jones outperformed, crude oil outperformed all the way back down. If we zoom over here, we had a massive outperformance of Dow Jones. It peaked in 2020. We're coming back down, and then we're going to do that same type of move where we could potentially come to this level up here and then compress back down where crude oil would outperform Dow Jones, just like it did back here. So we broke down, came back up, did a retest, and went all the way back down to the bottom here. This year was 2001. It was the recession of 2001. So we could see a pullback, slowdown, recession. I don't know how big it's going to be. That pulls us up maybe to this area. And it may not get completely to that area, but we're doing that type of move, and then I think we'll eventually turn. Dow Jones versus natural gas, another one that was incredibly cheap at the top here. I put a nice little pattern in here. We're working up where the Dow Jones was outperforming. We do a double top. Here's your double top potentially. And then I think natural gas is going to rip it against the Dow Jones. And we could compress down to levels that are insanely low. That would mean an outperformance by 98% decline. Obviously, it's going to be natural gas going up, Dow Jones going down. TLT versus gold. TLT doesn't have much for gold. It just looks like an outperformance of gold for the most part. Gold versus TLT flipped around. Big bull market in gold from early 2000s to 2011. Pullback 2015 onward, we're still outperforming. Could we see a little pullback here? Yes, we could. Natural gas versus Dow Jones. This looks ridiculous, guys. So this is natural gas this is Dow Jones outperforming natural gas. Came right to a corner, broke out, and just ripped it. This indicates different market conditions. Came all the way down to the bottom of 99. Bottom of 99 was the commodity to stock ratio bottoming. And then went all the way up to this very huge level up there. The outperformance here that natural gas could have is 1,612%. Obviously, it's a combination of this going up and Dow Jones or something, going down. I think natural gas looks very good right where it's at. It's cheap against basically everything. Copper to gold ratio. So copper to gold ratio, what this tells us is, bear market here when this thing dives lower. Another bear market in 2011, 2012. We've had some other bear markets in 2019 at the bottom of 2020. And we've been kind of moving lower here. Could we come back a little bit more where copper underperforms gold? Yeah, we could. Looks like we had a nice little move higher, but looks like we could go lower here in the short term with this bearish engulfing on the ratio. What does that mean? It means copper could underperform gold, and maybe we do have a slowdown in the market. Baltic Dry Index versus gold. Some people say, oh, this ratio, why are you comparing it? Guys, this is just an inflation adjusted Baltic Dry Index. And that's really what it is. Huge bull market from 1980 all the way up into 2007. We've been in a bear market ever since, and we're still in that bear market. And hopefully, we can get some traction here and try to break out of this thing. During a commodity bull market, we need to move a bunch of commodities around the world. If we're going to build all this stuff for, we'll call it the third world countries in the middle of their S curves, if they're coming out of it, I think we're going to be shipping a lot of stuff around the world at ever increasing quantities. And I think we could get a big bull market in the shipping companies. So that's also incredibly cheap, the Baltic Dry Index. Gold versus the Consumer Price Index. You can see that we're kind of hitting our head on this. It almost looks like looks more or less like gold. We've got a nice big cup and handle pattern that we're still working our way out. We've got another cup and handle here. Just kind of throwing it up there kind of quickly. And eventually, hopefully, gold will outperform the consumer price index at some point when money rotates differently in the markets. But that's what we've got for today, guys. Those are all the kind of ratios that I look at. Key takeaways here. A lot of commodities are still cheap. Platinum, cheap as heck. Baltic Dry Index, cheap as heck. And then we also have natural gas that looks really good. That is also very, very cheap. When things get at very low levels, what happens is substitution starts to occur. People are going to prefer to burn natural gas versus coal or oil when natural gas is cheap against it. And then what you see is just a rotation of users in the system that are swapping or turning their preferences towards whatever's cheap, which is the smart thing to do. And that's why these things cycle back and forth against each other. It's because they swap too much to one and then leave the other one, which then leaves it with lower demand. The reason these things go up and down against each other is supply demand of those assets, and also the market conditions where people favor certain assets over other assets. So it tells us market conditions, these ratios do, and it also tells us what's cheap, what's expensive, where the money is at, and where it isn't at. That's important because you have to, when you're an investor, you want to go where the money isn't at and is about to rotate into your assets. So that's what I use. This is a cornerstone of how I identify which assets are cheap compared to history. You're taking out the denominator, which is the dollar pricing, out of it because we don't know. It's not a stable value. And it's always best to see an asset versus an asset to see what's cheap in relationship to each other and give you those market conditions. All right, guys, that's what I've got for today. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys later. This is Finding Value.